Commercial real estate stress doesn't stay inside office buildings, it spills outward. And the next place it shows up isn't always markets, it's small business. Because the commercial real estate system is connected to local banks, local credit, and local cash flow. When refinancing gets harder and property values reset, lenders don't just lose confidence in buildings, they lose confidence in risk. And when lenders get defensive, they tighten credit across the board. That's the spillover. So the real question isn't, is commercial real estate crashing? The real question is, who gets cut off first when lenders tighten? And the answer is usually small businesses. Here's why. Small businesses don't fund themselves like big corporations. They don't have bond markets. They don't have giant cash reserves. They rely on bank credit, lines of credit, equipment loans, working capital, short-term financing. And they rely on relationship banking. So when local banks feel pressure, even if it starts in commercial real estate, they protect themselves the same way every time. They lend less, they approve fewer loans. They tighten standards, they lower limits. They demand more collateral, and they prioritize their strongest borrowers. Here's what makes this spillover so important. It doesn't hit everyone evenly. It hits businesses that need credit to operate week to week, restaurants, contractors, small retailers, logistics firms, small manufacturers, the kinds of businesses that live on cash flow and short-term financing. When banks tighten, these businesses don't always fail. They just get forced into defensive mode. They delay hiring. They cut hours, they stop expanding, they reduce inventory, they renegotiate leases, and the economy slows without a single dramatic collapse. This is why you often see a gap between headlines and real activity. The headline might say, commercial real estate is stressed, but the real-world effect is small business credit is harder to access, and that changes behavior fast. Because for small businesses, the line of credit isn't optional. It's how they bridge timing gaps between paying suppliers and getting paid by customers. So when lenders reduce limits or tighten renewals, it becomes an immediate operating problem. Now add one more layer, local banks. Regional and community banks are often the main lenders to local businesses. And they're also often the most exposed to local commercial real estate. So even if a small business has strong revenue, the bank may still tighten because it's protecting its balance sheet. That's the spillover mechanism. CRE stress gives bank caution, gives less credit, gives slower local economy. And once local economies slow, it feeds back into CRE through weaker tenants and higher vacancies. That's how a slow squeeze becomes a cycle. That's not a headline event. That's a slow squeeze. Now, why does commercial real estate pressure banks in the first place? Because banks are exposed in three ways. First, the value of the collateral changes. If property values drop, lenders won't refinance at the same loan size. That forces owners to bring in equity, sell, or restructure. Second, even performing loans become riskier when refinancing becomes uncertain. So banks raise reserves and get cautious. Third, regulators get more sensitive when they see concentrated exposure. That increases pressure to tighten underwriting. So banks become defensive, and defensive banks tighten credit. Now here's where small business gets hit. A small business might have nothing to do with office towers, but their line of credit comes from the same bank that's watching real estate risk. So when the bank de-risks, the small business feels it immediately, and it shows up in everyday operations. Inventory becomes harder to finance, hiring gets delayed, renovations get postponed, marketing budgets shrink, expansion plans pause. In other words, credit tightening becomes a growth brake. Now zoom out. Why does that matter for the economy? Because small businesses are a large share of employment and local activity. If small businesses slow hiring, the labor market softens. If small businesses slow spending, local demand weakens. If small businesses can't access credit, resilience drops. And when resilience drops, a weak quarter becomes a weak year. It's how spillovers become macro. So what should you watch if you want to spot the spillover early? 3 signals. First, bank lending standards and loan growth. When loan growth slows and standards tighten, the credit channel is closing. Second, small business confidence and business formation. If confidence drops, entrepreneurs stop taking risks, and that reduces hiring and investment. Third, delinquencies in small business and consumer credit. Not the level, the trend. When delinquencies trend up, cash flow stress is rising. Now here's the key idea. Commercial real estate stress doesn't need a dramatic collapse to cause damage. It only needs to keep banks cautious. Because when banks are cautious, they create a shadow recession in credit. Less borrowing, less spending, less investment, less hiring. And this is why the spillover story is bigger than office vacancies. Commercial real estate is a credit problem, and credit problems spread. So what happens next? In a lot of markets, the reset is slow. Properties get refinanced at lower values. Owners recapitalize. Some default. Banks extend where they can and tighten where they must. And while that happens, the easiest lever for banks is to reduce new lending. That's the spillover. So the takeaway is simple. Commercial real estate stress doesn't stop at buildings. It spreads through credit. And when credit tightens, small business feels it next. That's where you'll see the slowdown before it shows up in the big headlines.